Hello everyone. So please join it. We will start our classes. Class. Uh, can you give me the confirmation of audio video? Confirmation once you give after we will start our lecture. Okay. So please give me the confirmation that audio is okay and video is also okay. So in today's lecture, welcome to the Global Online Platform. I'm Dr. Swati, welcoming you to the Global Online Platform. So today we have continued our lecture. Voice is okay? Okay, so let's start. So today we are going to take the unit number. We are starting from the unit number 4, that is the business finance. You know that this topic is quite interesting, and yes, there is a create some confusion also, but I hope so this lecture will be going to be great for you. For today we are going to be started derivatives. Okay, this is a really important topic of the business finance. So let's start. Yeah, just before we start, just quickly tell you about the global online. So here you will get complete course of the commerce and the management, and you know that our new batches will be going to be started from the 1st of July, and every new batches will be going to be is conducted is announced in every Monday. Okay, and yes, the daily live lectures is available over here. Complete PDF format. Syllabus is going to be given over here, and then the full syllabus mock test, and the more than 4000 MCQ series with detailed explanation, PYQs with the detailed explanation, and here you will get paper 1 is free of cost if you register yourself for the paper 2, and the global online provide you 50% discount, and in the 5000 rupees you will get paper 1 plus paper 2, and the contact number which is given in your screen, get in touch with this contact number. So without delay, let's start with our topic of today, and which is really important and really interesting for you. So let's start. That is a financial market. Okay, so the financial, what is a financial market? Financial market is a market where the people trade in a financial security. And what is a financial security? You are very familiar with the things that is a share. Okay, the share market. Okay, so the share market is going to be very popular today now. Okay, so this is what this is called as ultimately it is a derivative. Okay, now what is a financial market? So in the financial market, it is categorized in the two parts, that is a money market and the capital market. But in today's lecture we are not studying about the money market and the capital market. We are just focusing on the derivatives, because it is having their own importance in your UGC net. Okay, so let's what is here, that money market and the capital market. Okay, so in the short, the money market is for the short period and the capital market is for the long period. Okay, now the capital market is going to be categorized in the two category. Okay, two concept. Okay, two markets. So first thing, that is good evening Rupali, good evening Chandra Kumar. Okay, So here what is going, it is the capital market is going to be categorized in two market, that is a primary market and the secondary market. So what is the primary market? Primary market is nothing but your IPO. And what is IPO? IPO, that means initial public offering. So what is the initial public offering? So in the initial public offering, what is happen over here? That is the company, the newly launched company, either you can say the company already in exist in the market, but newly issue their share in the general public. Okay, issue their shares in the general public market, general public in the market. Okay, so this is a first time whenever the company first time, what happened actually, the company first, if you want to open your company, so what do? You collect your capital from your own, either you collect your capital from your relatives, okay, either from the debentures, either in form of creditors, okay, or so these are the form you collect your capital and run your business. So what happen when the company grows up? So the company need more capital. Okay, in that case, they need more capital. So what happened, if they need more capital, they want more capital, so what they do, they offer equity share. They offer a shares, not equity, they offer a shares to the general public. Okay, general public. Okay, when the company first time enter into market for issuing his share, this is called as a initial public offering, that is a IPO. Okay, now what is the secondary market? So the secondary market having the two category, that is a capital cash market. You can say either it is a stock market or over the counter market, or over the counter market is nothing but the derivative markets. Okay, now let's understand what is the over the counter market. So over the counter market is a trading can involve the stock. Okay, what they involve? They involve the stock and bonds and the derivatives. Okay, and the derivatives. Now we will discuss a derivative. What is a derivative? You know that stock is a asset, bond is a asset. So what they using these things. Okay, now which are financially a contract that derive their value from underlying the assets, such as a commodity. Okay, they using as a commodity. What they are doing? They are not using this stock as a cash, they are using as a commodity. Why I use this word, that is a commodity? Because stock and the bonds, this is a kind of paper. Okay, this is kind of paper, and when you sell it, you will get a cash, you will get a money. So stock and bond is what? It is a commodity. When you sell it, then you will get a cash or money. Okay, that's why the commodity, this word is used over here. Now what is the over the counter? So in the over the counter, what is happening over here? There is a market securities are trade without what? Without being listed on an exchange. So here they are not using as a exchange, they're without exchange. So what they are doing? They're doing the OTG is doing through the dealers and by the help of the broker, especially in the over the counter market. They do not do the market or they do not involve in the market in the directly. You cannot enter in the market, you cannot purchase the share, you cannot sell the share directly through the market. Okay, this is not happen because there is a dealer. You have to go through the dealer and the brokers. Okay, now the OTC trading help in the small investor also. If someone want to purchase a 20 share, yes, it is allowed in the over the counter market. If someone has to want to purchase a 10,000 or the 10 lakh shares, so it's all the open for all the investor who want to enter in the market. So this is a over the counter market. Clear it? I hope so you understand the things. Now, so in the derivative markets and the capital market, these are the market which is regulated in the India by the SEBI. Who is that? Security Exchange Board of India. And I have request you that you have to tell me about the when it is going to be established, the act. Okay, act plus when it is going to be enforced or the established. Okay, establishment here. Commodity, I have, yes, the commodity, they use that commodity. Yes, Chandan Kumar, yes, this is a commodity, means actually the stock and bond is what? You can use a stock and bond in as a commodity. It's a, actually it is a not a actually asset, it is a underlying asset. The word is used by them, that is a underlying asset, because when you sold it, it's not actually asset, like a machinery. Okay, so when you machinery, you can see this, there is a machinery, you can sell it. Okay, so this is not so here the stock and bonds is a underlying asset. If you sell, because there is a some duration. Okay, when you purchase a stock, there is a specific time, specific duration is given. Okay, you if in the bond or in the stock, you can see that there is a time and date is given. Okay, and also the price, specific price, and also the specific what is going on? Okay, specific price is also given, it is written, it's like a this. Okay, so here all the date and the times and is given, so that's why it use a commodity, but it is a commodity like a underlying asset. Okay, yes, underlying asset is a stock or bonds. Whenever they use the underlying asset, this word you have to get in your mind, that is it is a stock and bond, ma'am. Okay, yes, Chandan Kumar, yes, now you understand. Okay, what I'm talking, that is you have to comment me in the comment box, that is a SEBI, because it is also important. You, if you are if you go through with your previous year question paper, they use the act and the year of establishment. This is an important thing, and you have to write it in your in I think whenever you do study, you just write it in your papers and just paste it in the wall, in a wall, so you can go through with this years. Okay, so here comment me the act of this AB, Security Exchange Board of India, and when it will be established. It was established. Okay, so yes, what is a derivative? So here we are going to discuss the features of the derivative. What is a derivative? What are the features of the derivative? So derivative having the two parties. Their derivative, in the derivative where they make a contract. Okay, because in the stock, in the bonds, you can see there is a paper and there is a contract. There is a contract and the legal acceptance is given over here. Okay, so in that case it is a contract, but contract between whom? Between two parties. Okay, and between two parties which is expected to settle the future date. What I have said in the last slide, that is a specific time, and the specific time and date is given, specific price is given. Okay, so in this derivative, it is a bond, it is a stock. So here is this for the future date, when it will be going to be sale, in how much amount, in the how much amount he was purchased. Okay, so this is a specific future date and the specified price. Okay, now the second point, that is a feature, is that it is a contract of buying something and selling. Okay, so in the derivative, what is happening, you can buy the share and you can sell the share. So these two things has happened. Okay, so to buy something and selling something, but in at a future date. So this is an important. So because we are get confused in the question paper, they can ask from this specific things. Okay, and we will get confused. They can ask the question paper in the present day, they can ask in the past amount, past date. So you have to be clear, that is a derivatives, it is selling something or the buying something, it is for the future date. Okay, clear? But at a at a price agreed today. Okay, they can ask the question from this point in as a assertion, as a single question paper question. So this is, they are for the future date, but for the price agreed today, which price is agreed in the today. If some share, if some stock having the price of 10 rupees today, okay, but after the 3 month or after the 5 month, the amount is going to be increased to the 15 rupees. So what they agree for 10 rupees, but the what is the balance, what is the difference is also given to them as a profit. Okay, so it is a 15 rupees is to be the future date is that means after the 3 month. Clear? After the 3 month, and but price agreed today, which price they are agreed today. Clear? Now what is derivative? Now the next thing, that is derivatives are the financial contract whose value is derived on an underlying asset or the group of asset. So derivative is a financial contract. Yes, because we are doing the financial things over here, whose value is derived on an underlying asset or the group of asset. And what is a group of asset and what is the asset over here? It is the underlying asset. So what is the underlying asset? Yes, it is a stock, it is a bond, it is a currency, it is a commodity, and in market index. And what is a market index? So here market index, it is a hypothetical portfolio represent a segment of the financial market. So what they do over here, they are creating his portfolio. Okay, and what is a portfolio? Here you purchase or sales, you make a estimation. Okay, you make a estimation of what share you want to purchase and what share you want to sell. So you will get this amount of profit. Okay, this is a portfolio. That means you're making your portfolio by when you're purchasing your shares, when you're selling your shares. That is a portfolio, that is a market index, nothing but it is a market index. Okay, the value of the underlying asset keep changing. Stock, bond, currency. Stock, bond, currency, these are the different things. Okay, so the stock, bond, currency I have already explained, Chandan Kumar, that is it is a underlying asset because they having this is a paper format. Okay, yes, these are the underlying asset. Now the value of underlying asset keep changing according to the market condition. They are not static. Okay, so this is also important. This is not a static, this is change according to the according to the market condition. Okay, so they change according, they can ask the question if they change according to the book value, if they change according to market condition, if they change according to whatever, so and so. So what you have to write, you have to keep in your mind, this going to be change according to what? According to their market condition, because derivative is related to your market, because it is a financial market. Okay, yes. Now it help in reducing the financial risks. Yes, if you make your portfolio, if you make your derivatives, what the underlying asset you want to purchase, you want to sell according to the market condition. If you see that there is a stock value is going to be decreases, so you what you do, you can if they're going to be decreases, so what you can purchase, you can call the shares. Okay, when the price is going to be increases, you can sell it. So what is happening over here, there is a very much up and down in the market, so there is a risk, there is a much risk about what about it is it's related to your financial risks. Okay, you have to suffer from the financial, so derivative helps to reduce your financial risks. Clear? So these are the features of the derivatives. Now okay, now I will give you the example with a numerical with numeric. Okay, so here you just think that you are in this market and you want to acquire 200 equity share. Okay, something some A limited company. Okay, and the price of share is 1000. So how much you have to pay? That is 2 lakh. Yes. Okay, now what you make a contract. Okay, you now make a contract for a future date, which I have already, that is future date after the 3 month. Yes, clear? That is your future date. Yes, but the price is for the today. Yes, the today's price of that share is 1000 rupees, but purchase after the 3 month. Okay, purchase after the 3 month. So you can buy 200 equity shares in a limited at a 1000 each. So here is a contract given to you is a right that after the, what they say, if you purchase after the 3 month letter, so what the 1000 shares, okay, so the 1000 the price of the 1000 share going to be increased to the 1250 rupees. Okay, so the worth of this contract is what? How much you extra gain in this contract, or how much extra you loss in this contract. There is not specific. Okay, if either you are purchasing, if you purchase this today, you will get a you gain in future. If you're purchasing after the 3 month, you are loss your profit. Okay, you're not you're in the condition of the loss. Okay, actually not a loss, you're losing something great. Okay, so now what is the difference between the between 1250 and the 1000? Yes, there is a difference, is 250 rupees. How much shares you have purchased? You have purchased 200 share, so multiplied by 200 multiplied by 250. So what is the amount of the share today? That is, what is the difference of the amount of the share? That is a 50 rupees. Okay, so this is example of the derivative. Now the value of the contract change. Yes, with a change in price of equity. Why it has changed? If you change the price of equity, it was the 1000 rupees, but now the price of this amount, price of this share is 1250. That is 1250. Okay, so the amount is going to be changed because before you purchase it in the 12, the amount of your share is 2 lakh rupees. Now when you in the future date, how much amount it will be? Comment me in the comment box. Okay, you should, please, you must be interactive. Just whenever I'm just keep the calculator with you. Okay, so comment me in the comment box. Okay, multiplied by 200, how much it will be? Now, so next, that is here now let's understand what is it. Here you know that the equity share is your underlying asset. It is your underlying asset. Okay, it is your underlying asset. Now you understand what is underlying asset. And in the derivatives market, okay, the underlying asset could be the commodity, which I already explained, the precious yes, Chandan Kumar, 2,50,000. Great. Now the precious metal and the foreign exchange rate and the interest rate related to financial asset and the market index. Clear it? Okay, yes. Now let's move ahead because we have now. Okay, now the participant in the derivatives, the one who participate in the derivative market, they called in a different name. Okay, so these name are the hedger, speculators and the arbitrageurs. Okay, so who is a hedger? Hedger, the person who do not want a risk. They are not ready, they are not mentally ready for taking a risk. So what they do, if it is, suppose you purchase, you are a hedger. Okay, so you purchase some share in 1000 rupees. Okay, 10 share in 10 rupees, 10 per share. Okay, so you purchase a share 1000 rupees. Now the hedgers are very insecure. They do not want to take a risk. They want to reduce their risk. They are very what is the word we have to say, that is that the restless. Okay, what they do, if they found that their cost is, they invested how much, 100 rupees. If they found that they will get 100 rupees, okay, back, so they are a hedger. Either you can say that is 100 rupees or 150 rupees, or you can say 200 rupees. If they found that I have invested 100 rupees and I have get 200 rupees, this is more than sufficient for me. So these kind of persons are the hedger. Okay, now who is the speculators? So give me thumbs up or say yes when you understand the things. Okay, so yes, now the hedgers and now who is a speculator? Speculator means who want to make a risk, who are very curious, they are really want to take a risk because they know that if you do not take a risk you will not gain more than your boundary line. Okay, so what they make a profit by taking a risk. Okay, they make a profit by taking a risk. These are called as a speculators. Okay, these are the person who is called as a speculator. They want to take a risk. Okay, so the speculator, like someone invest in the 1,100 rupees. Okay, but now not he 100, he want to purchase 1 lakh share something, because he is a speculator. Either you can say let's let 100 rupees. Okay, now the what speculator do, he wait until he gain a 1 lakh rupees. Okay, so these are the speculator, they want to take a more risks. Okay, yeah, generally hedging take place in the option. Yes, I will take, yes, I will tell you in the next slide. Yes, it will come. Okay, I'm just telling you that is it, what is it mean. Okay, now the arbitrage means they want to make a profit. Yes, they want to make a profit, but without taking a risk. It is possible. Yes, it is possible. Yes, how it is possible? What they do, they are giving the importance to the price yielding or the differentiation, or you can say price differentiation. Differentials, they give the importance. What they do, they purchase a limited company, and there are the B limited company, and there is a C limited company. So what they do, they purchase 100 share from this, they purchase 100 share from this company, they purchase 100 share from this company. Okay, so if they found there one of the company is going to be down, but both another two companies going to be increases, so what they are doing, they just investing there in the different market area. Okay, these are the market arbitrages. Okay, so let's understand that is the arbitrages, they are the player who objective is profit from the pricing differential. Okay, and the process of stimulating or buying or selling take advantage of this differentiation. Okay, if the one's company shares is going to be down, they purchase the another company share. Okay, if they found that another company's shares is going to be increases, so he purchase to the another company, and again so they are not stimulated, or they are not static to the specific company. They can do the share, they can trade in the different companies, or different in market. Okay, so these are the arbitrages. I hope so you understand. Let's all this shortly I will tell you that is a hedger is as a risk reduction. They are the player who is objective to reduce their risk, and the speculators is they are the player who establish the position based on their speculation in the future pricing motives. Okay, they having a very very large you can say that is speculation. Okay, their mind is going there because they are a risk taker. They are not thinking about a small profit, because they are they are just they are a risk taker. Okay, yes, now now let's understand that is what is OT, over the counter and the exchange trade. Okay, what is the over the counter trade, over the counter derivatives and the exchange rate. Okay, so the different exchange rate. So the marketplace of the over the counter is not centralized, it's not specific to the specific place. Okay, it's not specific, but in the exchange trade you can see there is a centralized, it's centralized in the one place. Okay, now the regulated OTG, over the counter. Okay, over the counter is self regulated. There is no need to regulate it by anyone. Okay, there is a self regulated. You can regulate your portfolio. Okay, but in the exchange trade, what happened, it's by the commission regulated. Okay, it's commission regulated. Then that in the trading you can see there is a negotiated contract. Okay, what is negotiation? You can see there is a negotiation in the contract in the over the counter derivatives. Okay, but in the exchange trade, what happened, there is a standardized contract. There is a no negotiation is there in the exchange trade. Okay, now the margin payment is a no legal requirement. There is no legal requirement. You have to register, you have to, but yes, there is need when you register. There is a PAN number is compulsory. Okay, PAN number or Aadhaar, I think Aadhaar card is also is compulsory. But when you are enter in the exchange trade, and you have to comment me or the in the comment box the examples of the exchange trade. Okay, so this is a homework for you. Now they need a legal requirement. Okay, now you have to, in this question you have to just make sure that is in the OTJ there is a less legal requirement, but in the exchange trade there is a legal requirement. Because why this is legal requirement? Because it is a centralized. Whenever the word is centralized is used, you have to make sure, you have to just understanding that is there is some legal requirement is there. Okay, you can see that is if the something is centralized in hands of a single person or the limited person, you can see there is a very much rules and regulations over there. Okay, now the transparency, you can see there is a no transparency because no data is you can see because there is a no legal requirement, so there is a less of transparency, there is a no transparency. But you can see because when in the place where you can see the things is centralized in the hands of one people, the things is having they are legally bounded. Okay, they having a standard contract. In that case there is they maintain their transparency because all thing is legal. Okay, now the credit and the default risk, here you can see there is a high risk, you can see high risks or the high chance of yes, you can see there is a high risks, and there is I'm not getting that word right now, and here you can in the exchange trade good evening Sudhir. Yes, in the exchange trade what happened, there is a low risk. Now give me the example of, I think in this point you will get the the example in your mind. So this is a English language, the class is going in an English language. ये क्लास इंग्लिश लैंग्वेज में है, सो वी विल नॉट गोइंग टू बी कंटिन्यूड इन बिकॉज इट इज़ फॉर द इंग्लिश स्टूडेंट. सो इफ यू yes, especially for the English student. Yes. Okay, then guarantee performance. In the guarantee performance there is no guarantee performance because you know that how they give the guarantee, because there is no legal, there is nothing is centralized. If you are self regulated the things, how it will be the guaranteed performance? They're not going to be, they're not comes under the guarantee performance. But because this but in the exchange trade what happened, there is a guarantee by the clearing house. So give me the example, do it fast. Still you not get the example of the exchange trade. Array fixed deposit, and one more which is issued by the RBI. One more thing you have to, which is issued by the RBI. They having a fixed exchange rate is one currency exchange is another country at a determined rate. I'm not talking about the exchange rate, it's like exchange trade. Okay, Let's move ahead. We have many things to discuss. Now the types of the contract in the derivatives. Types of the contracts in the derivative, you can see there is a forward contract, future contract, option contract, and the swap contract. But these are the contracts are categorized in the different because derivative having the two classified in the two things, that is the exchange traded, okay, and in the exchange traded there is a future and the option. Okay, Chandan Kumar, you are talking about the option. Here we are discussing this is an option, what the option, okay, and option is comes under the exchange traded. Okay, yes. Now the over the contract, it is a swap, forward, and the cooler. Clear? Now let's discuss it. The types of derivative, that is the first we discussed over here, that is a forward. Forward is related to your OTC, over the counter, OTC. Clear? So here what is the forward contract? Forward contract is an agreement, because every agreement is every contract is an agreement. Okay, so contract is an agreement between the two parties to buy or sell an underlying asset on a future period at a price agreed today, which I have already told you, that is a derivative. And when you are forwarding your contract, okay, so this is a forward contract in the for the underlying asset future period at a specified agreed amount at today. This is a forward contract. Okay, so here what is a customized contract? Over the counter contract, okay, and the obligations to the performance of the contract, and the non traded on the stock exchange contract. So here let's understand with example. If there is a farmer, okay, I agree and he agree, and I suppose you agree to sell the 500 kgs wheat at a 40 kgs after the 3 month. What? After the 3 month. And what? For making the bread. Okay, what happened after the 3 month? 3 month later, the farmer, what he give 500 kgs of wheat to the manufacturer, and manufacturer give to 20,000 rupees. Okay, so this is 20,000 rupees forward contract. So what is 500 multiplied by 40? So what is it? That is a 20,000. Okay, so they make a contract for the future date at which price? The price is decided in the today. If you see that if the price of suddenly after the within the suppose within the 2 month, the price of the wheat is going to be decreased. That means today's when they make a contract, the price is 40 rupees. Okay, but after the 1 month, what happened? The price is going to be declined to 30 rupees. So what happened? Because they make a contract for the forward contract, so what they do, they make a agreement of rupees 40 rupees. So that's why in that case what in the 3 month later what he do? Either he do the sell his bread, sell his wheat to the in rupees 30,000 or the 30 rupees or the 40 rupees. Yes, they make a contract for the 40 rupees. Either it increases the price of wheat or either it decreases. It's nothing going to be affect to the to that contract. Okay, if they make a contract of the 40 rupees, so it will be on the 40 rupees. Okay, so this is a forward contract, that you make a agreement between the parties of the underlying asset for the future period, but at a price agreed today. Okay, hope you understand this concept, and you have to because they make in the match the pair, in the matching list they can ask the matching question, matching list, they ask the question what is the forward contract, they give the forward contract, swap contract, and the future contract. Okay, so what is the forward contract? Forward contract is an agreement of the two party under okay, forget this two party, just the sale and sale or buy the underlying asset on the future period. This is important. Okay, this is important. Future period at a price agreed today. This is important. Okay, This is a forward contract. Now the next thing, that is a future contract. Now what the future contract is related? Your exchange traded. Okay, it is your exchange traded. Now future contract are the standardized contract which allow the holder to buy or sell a set at a agreed price at a specific date. Okay, if they the specific days, that means if they agree, if there is example is given over there. Okay, so here in the future contract, what they did, there is a standardized contract. So this is important. Okay, future are the standardized contract which allow the holder who hold that contract, okay, to buy or the sale the asset at agreed price at a specific date. What is the difference between the future and the forward contract? You can say in the future contract there is a future period at a price agreed today, but in the future contract, what is it is agreed price at a specific date, in which date you are comes into the contract. Okay, so this is important, in the specified date, agreed price at a specified date. Clear? Now the parties of the future contract are under an obligation to perform the contract. They are obligation to perform the contract. Okay, and what these contracts are traded on the stock exchange. Okay, this traded in the stock exchange. Okay, that's why it is a exchange traded. Okay, exchange traded. Then the value of the future contracts are marked to the market every day. This is also important. They mark the future contract. The value of the future contract are marked to the market every day. Specific day, agreed price. There make the price of this particular contract is going to be as per according to the market price every day. It is okay, it means that contract value is adjusted according to the market movement till the expiration of the date. That means in the forward contract you have seen that if they agreed for the rupees, the farmer is agreed for the rupees 40 rupees, but in the market, but this in the specific so this is a the 40 rupees, but if you are in the future contract, if the price is going to be fluctuate, okay, in the 15 days price is going to be 20, after the 15 days price is going to be 30, and after the 15 days price is going to be 40, and after when the date is going to be expire, after you can see after the 3 month, okay, after the 3 month the price is going to be 50 rupees. So these 50 rupees, it is your the contract price. Okay, this understand, that is a future contract. In simple word, future contract is the amount or the value of the contract is fluctuated or adjusted according to the market movement till the expiry date. Okay, suppose in the last date, suppose there is a 3 month duration. Okay, in the after the 3 month duration, in the last day of a 3 month duration, that is a 31st, suppose they agreed for the 1st of Jan. Okay, Jan, Feb, March. Okay, in the 31st March, the price of the wheat is going to be 50 rupees, but one day before, in the 30th of the March, the price was suppose 40 rupees. So it will what he will consider, 40 rupees or 50 rupees, he will consider the 50 rupees, because expiry date is given till the expiry date. Okay, the movement of market we count till the expiry date. Now what is the future? Future is a standardized forward contract, a trade on the organized, we have already seen. There is a standardized like a quantity of underline, quality of underline, okay, delivery date and the procedures and the price quoted, what are the prices quoted. Okay, now the next one, that is option. So option is also a exchange traded. exchange traded. Now here is what is option. Options derivatives contract that give the holder two option to buy or sell the specific quantity of the underlying asset at a specific price during the certain period of time. If you lapse that time, specific period of time, so this contract going to be invalid. Okay, so what is here? There is a specific, the underlying asset at a specific price during the certain period of time, during the certain period of time. Okay, so this is important, that is during the certain period of time. Now the word option means option, that is a holder has a right to has the right but not the obligation to bind the underlying asset. They have a right, yes, they have a right, but they are not obligated. In the future contract what we have seen, there is an obligation. The word is obligation is used over here. Okay, but it's not in the hands of obligation in case of options, because this is an option. The word is simple, options. Yes. Now the option seller is known as the option writer. This is also important. Okay, so the option seller is known as a option writer. The specified price is known as a strike pricer. This is also important. Yes, so the specified price, whatever the price is specified, this price is called as a strike price. What is called? It is called as a strike price. And the option seller who sell the option, he is called as a option writer. Okay, now you can exercise the American option at any time before the expiry of the option period. Okay, so the American option you can exercise at any time before the expiry of the period. But once the expiry date is done, so you cannot exercise this kind of this American option. Okay, now the European option. What about the European option? So in the it can sorry. Okay, so however it can be exercised only on the date of expiry date. Okay, only on the date of expiry date. Okay, here is before the expiry. Okay, before the expiry, and here is on the date of expiry. On the date of expiry. So before the expiry, if they having expiry of 31st March, okay, so in the before so the 30th of the March, okay, you can exercise the American option. But what is about the European option? You can exercise only on the date of, that means from if you are having expiry of 31st March, so you can exercise this European option in till the 31st March. So the last date, till the last date, European option is valid. Okay, now the next, that is what is the types of options. So here there are the two types of option. You know that this is the call option and the put option. So let's understand the two things in a detail. That is what is the call option and what is the put option. So what is the call option? So call option is nothing but when you buy the share. Okay, and put option, that means when you put, that means when you sell. Okay, sale. So here what is the call option? So call option, here you can see, that is a right. In the call option is a right to buy the 100 Reliance share at a price of 300 rupees. So 300 specified price is called as a strike price. Okay, and who sale, okay, who sale is called as a option seller. Okay, yes, per share after the 3 months. So the after the 3 month is a expiry date. Okay, the current price of this product, this share is 250 rupees, but they agree for the 300 rupees. Okay, this is a strike price, and the premium is to 25 share, amount to buy the amount to call option is 250. So how to calculate it? 250, 250 current price, okay, multiply by how much share they purchase, that is 100 rupees, 100 per shares. So how much amount? That is a there is something mistake. No, this is different. Okay, so here suppose after the 3 months, okay, after the 3 month market price is price of rupees 400, okay, then the option is exercised, that is the share are bought in net gain, that is 40,000 and minus 30,000 and minus 250. So this is this 2000 and 2500, sorry, 2500 this amount is amount for the buy call option, okay. So what we do over here, so if you buy the share of the Reliance, that is a 300 shares of rupees 100 share at 300 rupees, so how much amount? 30,000, clear. But the market price of the share after the month, okay, after the 3 month, after later the month, so the market share of the rupees is 400, and how much you purchase? 100 share, so this is a 40,000 rupees. So what we do, 40,000 minus 30,000, and how much the amount, that is they have the amount to be amount to be the call option, that is the amount is given, that is 2,500, okay. Suppose this, I will explain it again, okay. Suppose after a month market price is 200 rupees. Let's, okay, I will explain it again. Let's see over here, like right to sell, okay. So what is going on here? You can see there is an 100 share. Suppose you want to purchase 100 share of the Reliance company, okay, at a price of rupees 300 rupees. What is the price of per share is 300 rupees. So how much amount you have to of your share? That is a 30,000 rupees, okay, understand. Now after a month later, what has happened? That is a market price of rupees 200, okay. So the market price of that share is 200. So what is, you purchase 100 share of rupees 200 after the month. So how much amount? That is a 20,000, okay. And how much amount of your option call you have to buy? That is a fixed amount is given, that is a 2,500, okay. So what we do over here you can see there is a 10,000 difference, okay, after a month, because you are in a loss. And again, because there is an amount to buy option is fixed amount, that is a 2,500, okay. So how much amount? That is 7,500. It is your share value for the today after the month. If the price of the share is going to be decreases, because at the time of contract it is a 300, but later than it will be it was 200. Hope you understand till now. Yes. Now the suppose month, after a month market price is rupees 300, okay, at the same amount 300, the option is not exercised, over here, okay. So what they do, they have a they do not have a loss of rupees 30,000, because they purchase 100 share at 300 rupees, that is they have the amount he has spent, that is a 30,000. But what he say, the option is not exercised over here. If the option is not exercised over here, so here you will not loss for every month 30,000 rupees. Here you have to be loss of rupees loss of rupees, that is the whatever the premium amount, because here is not specified in this question, there is not specified that is the how much the premium amount, that is if they are having the price of 300 rupees, what is the actual amount, that is a 250, and how much the premium amount if they are having sorry, this is not 250, there is an 275, there is some mistake, there is an okay, there is an 275. So how much premium amount, that is a 25. So whatever the premium amount is, it will be your loss, nothing else. Okay, so that's why the premium amount is 100 share multiplied by 25. So how much? 2500. So this is your premium amount. Clear? So and this premium amount is nothing but this is a buy call option price. Okay, that's why we deduct this price as a premium amount. Okay, so in the premium amount, hope you understand, hope you get it, no? Can we move ahead? Yes or not? Oh, so this is a put option. Okay, put option, that means we have to sell in when we sell it, so there is an okay, and now call option. Okay, so what happened in the call option? Call option, that means when you buy, okay, in the buy option, what is the amount of this? So this is a premium amount, how much share you purchase, that is a 100 share, so premium. So this is a amount to buy for buy the call. Okay, so that is a 2500 rupees. So what happened, there is two things is happen, either the after the month they increase the market price, the market share of your price of the share is 30,000 rupees. Okay, but what happened after the month, market price is going to be increases to the 400 rupees. So here 100 multiplied by 400, so here is a 40,000 rupees. And how much premium amount you have to pay, you have to deduct that price, that means that is the answer is 40 minus 30, that is 10,000. From the 10,000 you have to reduce your premium amount, that is 2,500. How much amount you will get? 7,500. Okay, and what happened if the price is going to be decreases? Okay, so in that case 30,000 is your market price of the share, but the market price is going to be decreases, you have purchased 100 shares of 200, so 20 rupees. Okay, sorry, 20,000 rupees. So there is a difference of 10,000 rupees, but what he say, then the option is not exercised. If the word is option is not exercised, in that case you have a loss of only and only premium amount. Okay, so you will get over here, that is your 30,000 minus 2,500. So here is 27,500. It will be your price of your share. Okay, so here if the price is decreasing of your share in the market, so the whatever the premium amount you have to pay, this amount is only and only your loss. Okay, now what are the swap? So swap is the two counterparties agree to enter into the contractual agreement within they agree to exchange a cash flow at a periodic interval. Okay, so here the most swaps are traded over the counter, because we see that as a in the over the counter, because we see that over here, that is, yes, the over the counter, the swap is comes under the over the counter. Now and the sum are all the trades or the future exchange market, on the future exchange market, because it is over the counter, and you know that the over the feature of the over the counter, it's less regulated, and they having no legal foundation. Because they having low legal foundation, there is a high risk. So this is the feature of the swap. Okay, because it's treated as a over the counter. Clear? Now let's understand in very short, let's just summary. This is the last slide of our. Okay, so here the swap, let's understand with swap. Swap is interactive derivative tools. Okay, and the most involved exchange of the fixed cash flow or for a floating cash flow, and is similar to the other types of derivatives. Swaps can be commodity, it can be currency, it can be interest rate or more. So it is as simple as, because it is kind of commodity, it is kind of currency or interest rate or the more thing. So this is a swap. What is a forward? Forward is agreement to buy underlying the asset at the specific rate, specific date in the future. Okay, more flexible than the other derivatives, and the contracts are customized over the counter trade, and the higher the counterparty credit risk over here, because the risk is higher in the forward contract, because it is a statics. Okay, because it not change according to the market fluctuate. But in the for future contract, there is a similar to the forward contract, but the trade on the established exchange, the parties to the contract cannot trail the contractual option, and the fixed format, size is fixed, expiration is given, and follow the daily settlement procedure. What is the option? In the option, the given holders have a right or a not to obligation. They have a right but do not to have an obligation to buy or sell the underlying asset at a specific period of time or date. Okay, right is only available to the buyers, and for the seller, option are the obligation. For the seller, option is obligation, but for the buyer, it is only right. Okay, so now yes, here the thing is used, that is a yes, right is word is for the buyer who buy the option, and obligation is only for the seller who sell the share. Okay, two types, call option and the put option, we have already discussed over here. Yes, so we have completed over here the derivatives.